In this interview, I talked to Sean Bennett, the co-founder of Stronghold. Stronghold is a financial infrastructure company whose powerful tools provide fast, secure, and accessible financial services. The company has raised roughly $7 million in VC funding, and they've dedicated a $100 million investment arm into investing in the future of crypto and fintech projects. Sean and I talked about the origin story, how they started the company, how he met his co-founder, what they see in the market, what the challenges are of integrating both crypto and traditional finance worlds together, and where they're headed in the future. So I hope you enjoy this conversation. If you do, please give us a thumbs up if you're on YouTube, or a share if you're on the podcast. And I hope you enjoy. Here is Sean Bennett. All right, Sean. I was doing some research prior to our pre-show on Stronghold, and I want to ask you, starting with the origin story. You and Tammy met. I'd love for you just to articulate what was it in the early days that you saw that made you convinced this was a concept worth diving down. And thanks for joining. I'm excited to chat.
Yeah, thanks for having me. Yes, great question. I love going through our origin. And to start off with, I came across Bitcoin back in 2011. And it was interesting to see this sort of new programmable money. But at the time, to myself and to my co-founder Tammy, it was very much an alternative money, right? We're still used to using those traditional currencies. So it was 2013, or coming into the start of 2014, when Ripple actually open sourced their ledger, XRP ledger, right? It was actually closed source for a while to begin with. That they were starting to push, hey, let's put other assets on top of blockchain technology and move those around. And they were very interested back then in stablecoins, actually. And so now we were starting to see some small startups moving traditional currencies on top of blockchain technology. And it was that really, inspired me and got me interested in the whole blockchain piece. At the time, I was actually at medical school, and I was, slowly tiptoeing into the space, but it was that event that made me think, okay, this is really what I'm interested and passionate in. Let's take the plunge and do the startup game in this space. Why was it that traditional currency movement on top of blockchain was so interesting? My mother's side of the family is from the Philippines. So, remittance was a thing that I was used to around the house, right? Sometimes on the way back from going to town, I lived in the country. My mother would bring me to, the local post office, and she'd go to Western Union, right? And she'd talk about, the exchange rates and the fees that she was getting that day, because, for the small amounts of money that were being sent, those were hugely impactful to her, and especially the family receiving it on the other end. So, she'd be trying to time when the exchange rates were good and, when they had fee promotions and that sort of thing. So I was always fascinated with cross-border payments from an early age. And so when the prospect of having, New Zealand dollar, US dollar transferred over blockchain technology, saving businesses and consumers cost and making the process a lot faster and with better access, that's when I thought, okay, this is what I care about. Let's look at this space more. Tammy at the time was working at Ripple. She was their first head of growth, which in mid-2014 had just, Jed McCaleb had just spun that out of Ripple. Because it was the same technology as Ripple, which I had started to build a startup on, I quickly, met Tammy.
Sorry, let me pause you. Is that Stellar you meant to say, or is it Ripple? She was head of growth at Stellar?
She was head of growth at Stellar.
Oh, Stellar. Okay. You said head of growth at Ripple. I just want to make sure.
Oh, sorry. Yeah, she was head of growth at Stellar, which had just sort of branched out of Ripple at the time. So it was similar code base. The technology worked the same. And because I had already launched some early stablecoin products on top of Ripple, I was a day one gateway, as we called it, or anchor on the Stellar protocol as well. So, I was looking at doing New Zealand, Australian, US dollar stablecoins for cross-border payments. And Tammy was, promoting the use of Stellar to consumers and trying to get partners on board. And we were, there was quite a geographical distance between us. She was, in the US, I was in New Zealand at the time. But she came to New Zealand for a wedding, actually. And so we had our first meeting in New Zealand when she came around for that. So it was quite serendipitous, actually, the timing on that piece. And so, we did some early work together. We partnered on a few initiatives on top of Stellar. But, back then it was still too early, it felt, right? The rest of the ecosystem was still coming along. It was very, very hard to get good banking access back then. I mean, it still is now, but especially back then, banking access was incredibly difficult and businesses were just not ready to adopt it. There also wasn't the sort of institutional investment that we see now, or venture investment into the space yet. So while it was a fantastic experience and we had a lot of learnings, it was just too early to be really, pursuing our own startup at that stage. So, that's sort of where we met, and we did some work in 2014, but it wasn't until a few years later that we regrouped together and started Stronghold off. In the interim, I went off to Australia and worked in a compliance startup that I co-founded. And maybe I got my love of compliance and how compliance can be applied to actually increase access. Interestingly, I think in certain industries, and that ties back to Stronghold. We can get back to that. Tammy went and worked in venture capital. Great experience to have for what we were about to do. So it was in 2017 that we came back together. There was sort of a bull market in crypto. A lot of VC funds were putting money into the space. We had just, I think, come out of a lot of the ICO raising. There was still a lot of it going on, but there was that sort of original wave. And so Tammy and I were interested in, creating a startup to help with cross-border payments using blockchain technology. So similar to what we were looking at a few years earlier, just with better resourcing, a slightly more mature, invest community and ecosystem had evolved. So it felt like a better time to be doing it. And so that's when we kicked things off.
And so Stronghold's raised $7 million. What exactly is Stronghold doing in the world?
So yes, we've raised about 7 million to date, most of that in our earlier years. Stronghold is very much about giving financial access to businesses to be able to process payments, whether that is through traditional or, blockchain means. One of the major things that we do is help to bridge the traditional world where, you have most of the transaction volume today with some of the new technologies that you find in blockchain and DeFi. So we're very much interested in looking at DeFi, the concepts there, taking bits of those and feeding them back to our customers, whether they're really aware that there's actually blockchain being used or not. And for us, it's important to not necessarily just put everything on blockchain because we can. We use a lot of, very traditional payment rails where we need to. So, we've got normal old US domestic ACH wire in there when we need it. But for some of our, products where it makes sense, we'll bring blockchain in and give that to our customers. So we think of ourselves as a one-stop shop for payments in particular industries, and it's generally ones that have high compliance burdens as our niche. But we're also sort of one foot into the blockchain world on their behalf, right? Without them having to worry about how to navigate it.
Gotcha. And what's working? So like if you kind of break it down either by industry, demographic, or like where do you see product market fit the best?
Yeah. So, one of the big booms for us was during the COVID era where a lot of merchants wanted to, digitize their payments because they were still very cash heavy, right? And these were merchants that had, for one reason or another, difficulties with banking, good banking, or access to capital. So, examples of these could be businesses that work with, age-restricted products like alcohol, right? There's no problems about legality, but for banking, there's still an extra layer of risk and compliance that these merchants need to go through. Another good example would be like sports betting and gaming. Still for a lot of those businesses, they cannot get the banking access that we think they deserve. And for us, it's very much about trying to end financial discrimination by giving access to those particular players. So working in those industries to convert a lot of cash and some of their other payments over into, say, even one step further would be, let's take cash and turn it into ACH bank debit from your consumer, right? That was a huge win for them. But they had absolutely no access to that. And it's, it's a sort of boring. It's not that exciting, but the impact to our customer was immense. And that's where we saw a lot of revenue growth in 2020. As time goes by and, those opportunities are obvious, but we want to keep ourselves sticky with our customers who are the businesses. We also do, have consumer facing products, but it's all about the business. Where we've seen some recent growth is in taking elements from DeFi. So access to capital is one of our big pieces at the moment, where these businesses, they can hardly get banks. They're certainly not going to be accessing traditional capital. So, say a business might want to, open a new store or buy some inventory so they can do some promotions, or, hey, we're having cash flow issue. We need to pay for our health insurance dues for our employees. It was a real case we had recently. Because we're processing their payments, we can give them cap advances, right? But where do we source that capital from? Well, traditional sources it's not going to work. This is outside of their risk tolerance. But we have, DeFi investors who are totally fine with these sorts of merchants. We can access capital there. By the time the actual merchant sees it, it's just an ACH deposit in their bank account. So that's sort of how we're, getting value from one side of the house, so to speak, placing it in a business. They make their payments through, deductions and fees, and we can, remit the payment back to the DeFi investor. So that's one of the most exciting things I think we're doing right now, sort of bridging those two worlds.
Yeah. Kind of parsing out two themes here. One is that the fringe businesses out there that struggle to get bank accounts, whether they're in like gambling or, some area that's not illegal, but it's like high risk, that makes sense.
Absolutely.
You guys, and then getting access to liquidity using DeFi on that side is helpful. So it's like getting access to DeFi,
Absolutely.
getting access to liquidity there, and then allowing. You mentioned one thing I want to just push on a little bit, or just it's better understand. You said the mission is to remove discrimination in banking. I would imagine that there's a more nuanced ambition there, where if certainly you want some discrimination, right? Banks don't want to have illegal businesses using them. They don't want to just be like wide open. So they have to discriminate who is worthy of a bank account and who is not. I would imagine that the banks and generally all businesses would be financially incentivized to take on everyone they possibly can. And so that means everyone who's legal to do so. That would include things like gambling, porn, gaming, like high risk, violent games. Like in theory, it includes all those things which are legal. But then the bank restricts that. Why do banks restrict things that don't necessarily introduce a financial risk, but have kind of like a almost like sticky moral stigma to them? Yeah. I'm curious, what's going on behind the scenes in banks? Like, are they having this debate internally, and are they being strategically minded with quantitative analysis on this, or is it more some sort of like political branding exercise?
Fantastic question. I think there's very much a sort of both of those things are happening, right? Particularly in, sort of your neobanks or banks that are really looking to care for new industries or startups. They are doing that quantitative analysis on, okay, it's going to cost us this much to do extra compliance work because, we might need some of it in-house, but look, our regulatory authority that oversees us will want more information and more reporting, and hey, our credit card processor needs more information and more reporting, and, their IT services need more. There's sort of these layers of different reporting that keep getting added up. And it's not always just that one firm. It's actually what their partners are really demanding in terms of, transparency on whatever industries they're looking to serve. So there's a huge cost involved in that. It's immense. And so for a lot of companies, it is the juice worth the squeeze on opening up to those. We've found in, one of our major assets is the number of banking relationships and the strengths of those that we have, right? We have certain banking relationships that will only work with us in certain industries as well, right? So we have to, juggle and be very careful about, where customer money is moving. But we had conversations with them, and it is very much showing them, hey, here's the projected revenue that we think we can bring to you as our banking partner from this particular endeavor. You've seen what we've done over here in XYZ industry. Here's the next 3 years in ABC industry. And look, you'll be the first bank to do it, or, there's huge opportunity for us. But they always have to take that back and do their internal cost analysis. Oftentimes we'll get past that hurdle. But then the other one, and the one that we think is a lot more unfair, is going to be that more political, moral stigma piece that definitely exists. So even if we can show them clearly on the numbers side, hey, it makes sense from a revenue point of view, particularly with deposits, being an issue for a lot of the banks out there right now. We still get stuck with, the one word in the application that looks bad. Oh, this is sports betting or whatever it happens to be. The stigma is still huge on that piece. And so that's where we're trying to bring in our own services to get around some of those issues.
And is that stigma there because there's ultimately like a backdoor tethering from government accountability to the banks? Like I would imagine after 9/11, at least in the US, the Bank Secrecy Act really deployed this political policy or regulatory policy of the government has like read access or admin privileges behind the scenes to banks. And so if banks take on a customer that's doing something illegal, like it's ultimately the banks who are going to get fined. And so I would imagine that like each one of these things, whether it's gambling, whether it's like, what else is for instance, like porn, crypto, like these things are, yeah. I mean, crypto is definitely in there because crypto, they each introduce an area that has, it has, in order for it to be socially fringe, it has to have a regulatory wall around it. Like, porn legal in the US, but not if you're underage. Crypto legal in the US, but not for money laundering. Gambling legal kind of in the US, but of a certain age and a certain type. It's like psychedelics legal in the US sometimes for certain brands, for certain ages. So there's like a navigational channel that companies have to wade through. And of course, companies are financially incentivized to like push those boundaries, to want to take on more than is like technically legally. And so it's often interpreted, the law is changing. And the banks are like, oh man, we're basically taking on part of the risk of your decisions. And I would imagine that that's ultimately what's going on. Does that make sense to you?
Yeah, absolutely. That's a huge part of it. Every partner along that chain bears their own risk, but it does ultimately fall back onto who's actually moving the money. And usually that's going to be near the bank. It's going to be them doing it. We think that it's not always the AML problem that is the major blocker though. We've had times when, compliance ticks off from an AML point of view, but somewhere at the board level, someone just really doesn't like it. We think the discrimination is a little bit more institutionalized than that in some spaces. But yes, AML is a very easy excuse to use. We think is really what's happening a lot of the time.
So your thought is really that there's a lot of banks out there who won't take on customers because someone on the board of the bank just doesn't like the industry, or
sure. I mean, I shouldn't suggest that it's going to be, one person on a board somewhere, but by the time it comes to a sort of non-quantitative decision, it's sort of, a final check, like almost like a gut check from them. There'll be enough, there'll be a blocker up at that level that may not be driven by a quantitative decision, right? Or it's not necessarily a good risk-based approach that's being used. It is some sort of stigma or other reasons dressed as AML or risk.
And what are you seeing, or what do you make of the shift from these kind of centralized-ish banking system to DeFi, crypto? Do you see this as being a relatively smooth process over the medium and long term, that governments kind of put out regulations, companies are started, eventually governments adopt these more and more? These things grow, and then, meanwhile, behind the scenes, government fiat printing machines just dwindle down? Or do you see this heading more towards like a conflict of incentives between the incumbent financial system and the new decentralized system?
I think more on the latter. I think they're going to survive at odds. They'll continue to be at odds with each other for a long time, as far as I'm concerned. I think that the way that the industry is approaching it right now is still to build it's sort of two different neighborhoods are being built at the same time. They are so separate at the moment. And that, I think, would be my biggest ask for the industry if I had to have one. It would be we need to think about integrating those two sides now, really, really early on. I think that a lot of DeFi is built for DeFi.
Mm-hmm.
The world that I live in Stronghold, is, the day to day is very much everything we do is about empowering the business. Great to have great technology. We'll search for that. We'll, tap into it and make use of it. But if there's no easy way to integrate that with what we're doing for real customers at a real transaction volume, it's useless from our point of view, right? So I think there's going to be great access for individual consumers in the future to use DeFi products. So, access to payments, access to savings and investment vehicles through DeFi systems, and how regulation will touch those is a huge question that I, don't have any great answers to. But for most of what a consumer actually ends up interacting with, via businesses that they're using, they're still going to be, on the separate system. And sure, they might introduce, blockchain or some decentralization there, CBDCs, that sort of thing. My worry is that these two things will be very separate going forwards.
These two things being the banking system and crypto world?
Yes.
Yeah.
Particularly DeFi. I think the crypto payments will integrate a lot better. And we are seeing some good integration of crypto payments through, traditional banking. But I think DeFi and all the exciting financial services that can bring is still going to be somewhere off on the side, or just separate.
I almost see it as a difficult integration to make, because DeFi inherently is like the whole exciting aspect of the proposition is ultimately you're in control of the money. Whereas if you have kind of this blend or hybrid case with, Celsius being the most famous recently, where they're like offering a lot of the benefits of DeFi, but then they're centralizing the control of it. And, that can clearly go wrong, as in their case. It seems like other competing company like BlockFi was another one that kind of bit the bullet on that. But Nexo is a company also that's out there. It's like a pretty big company that's managing multiple billions and seemingly doing quite well. Do you see this as a individual fuck up basically on Celsius's side, or are you more bullish on the strategic direction of a business that integrates DeFi with centralized ownership and custody? Or how do you sort of see the actual connection between the two worlds?
Yeah, that's a good question. Obviously we inside of Stronghold, we have our own approach to how we bridge, customer money into customer money into DeFi. It's more the other way around. That's, where we can access capital. So it's an easier problem there. We're also experiencing where, we've deployed funds into an Alameda pool through Maple Finance, right? Where Stronghold has invested its own money, not customer funds. And, that was actually relatively easy as long as you're very, very aware of how blockchain works. I think that where the difficulty will always be is that the more control the individual user has over their, their own accounts, their own funds on chain, say before it even hits the particular DeFi networks, it's just going to be very hard to onboard that user in it all. So I do like the sound of having those centralized providers that offer access into, DeFi style savings and investments. I think the biggest problem with players like, Celsius is they were just their own fund managers, so to speak, and the user didn't really realize that in a lot of the cases. That's just some clear problem with communicating what the actual, use of funds were or what that product was. I would disagree with the model entirely. If it was being, presented as safe, then, it was an investment fund. If it was being presented more as access to DeFi, well, it really wasn't. I think that in my ideal world, a hybrid would look like you would help the user get access to the DeFi protocol, but they would still have the, complete transparency and actual ability to, use protocol specific features themselves. But they're not, going to an exchange, buying stable coins, downloading MetaMask, transferring funds in that way, worrying about where their, Ether fees are coming from, that sort of thing. So I think that's probably where I'd like to draw that line. But, transparency is the main issue there, I think, with these big blowups recently.
Yeah. Yeah. It does seem like there's not an inherently bad business model, but you have to make it clear what you're doing with people's money. Because if you say, hey, we're going to hold it and we're going to make some investments on the side, like if you're getting into a hedge fund, you say, okay, some percentage of my portfolio is going into this hedge fund, it's high risk, it might go to zero, it might, drop down 10x, whatever. But to put it in a company that looks like a bank, feels like a bank, it's all about interest. And if you're making, 6% interest, 8% interest, you're not thinking like high risk investment. And so, yeah, totally agree with you.
Absolutely.
Yeah. Have you followed the stories there closely with Celsius, BlockFi, Alameda, Luna's? Have there been any? Yeah, it's in your domain. Has it been sort of top of mind? Like what goes on in private channels? Is this like earth shattering, or do you think this is like a bump in the road?
From Stronghold's point of view, it's more of a nuisance than anything, right? We did actually have some money through Stronghold Capital. We launched a $100 million fund, I think at the end of last year, and to invest in underrepresented founder funds, and some of that money actually ended up going to Alameda through Maple. So we had our eyes on that to see what happened to our deposit there. Maple was fantastic, and there were no issues. It was totally safe. But the main problem for us really is not necessarily market pricing, however that goes. Stronghold is, although we do have a crypto side and we also have our own token, we're very much, I'd like to say a normal business, right? We have normal revenues that are totally disconnected from blockchain, and then we pepper in blockchain-based services on top to make us more sticky, extra revenue. Those extra revenues are not impacted by a bear market, say. But from a perception point of view and ongoing regulation, and from a risk management point of view at our partner banks and at businesses, having all these stories all over the news and senators talking about it, that sort of thing, that's what is problematic for us, right? And progressing discussions with future partners and businesses. So the fact that blockchain or crypto gets talked about like that, that's the problem to us. And so we'd like to see less of that going on as much as possible, or at least not to tar the whole industry from a couple, firms' bad decisions.
I want to ask about this $100 million fund. So where did the money come from? Why launch it? And how is it being deployed?
Yeah, great question. And so, Tammy having, some expertise in the VC space from some, stuff pre-Stronghold, she was at 500 Startups, where she was very much on the capital raising side, actually from investors. So the other side of the house than where she is now, on, raising for Stronghold. Stronghold Capital was launched very much to put, money where our mouth was in terms of targeting, founders and businesses that we feel are underserved. And I think, not the general underserved or underbanked that people are talking about. Locating founders, of color or that don't have prestigious backgrounds in the US, no fancy university or colleges. Tammy's from the South. I'm from, rural New Zealand. Felt very important to us. The funds for Stronghold Capital have come off of Stronghold's balance sheet. We've committed $100 million. I cannot remember how much we've deployed so far, but there's been, I think, 3 or 4 investments that we've made, which are all public out there. At least 2 of them have been into funds, VC funds that invest onwards onto underrepresented founders. And we also made that Alameda contribution through Maple. So still early days for deploying the money there, but it's very aligned with what Stronghold does as a business itself.
I want to ask you a little bit about that. So just to put it in perspective, like if you guys started in 2017, raised 7 million, have a team of roughly 25 people, in my experience, in a past startup, I raised about 25 million. We had about 60 people, and we certainly did not have 100 million in the bank, from growth. Are you just seeing absolute rocket ship revenue, or is there some, like, how do you get 100 million given 7 million raised, 25 people on the team, and 4 years old or 5? Is that
Yeah. So for us, we raised our money. I think the last money came in just prior to COVID or around that time. From there, if you can think back to March 2020 and, how people were feeling with that uncertainty, we really made a conscious decision that we need to focus purely on our revenue 100%. Raising money is going to be hard. Many of the same conversations that businesses have need to have, this year. We needed to be positioned going into COVID as well, like that. So for us, it was important to target that traditional, non-blockchain based revenue, because at the time we had startups using our platform APIs, but we were incumbent on them to grow their transaction volumes for us to make more revenue. So that's when we ended up going, sort of direct to business or direct to, point of sale companies or e-commerce website builders to integrate with them, and then we could sell onwards to their merchants. So at that time, we went from, running like the traditional VC model of we can, hey, grow, burn. We can always raise money based off our metrics to, okay, let's just totally focus on revenue and profitability. And so by the end of 2020, we were riding that profitability curve, right? We were seeing exponential growth on our revenue, and we were only hiring or burning funds basically to match that. And we've been trying to follow that ever since, which has put us in a fantastic position for the current economic, climate, because we've basically still been following that model. So, we have had that growth, which has allowed us to hire, but it does limit what we can do, or it means that we have to be very, very focused about what we go about doing. So where does that 100 million come from is a fantastic question if we're sort of riding that profitability curve. We do have some excess funds based on our growth of revenue to deploy into these areas. And the 100 million is our total commitment. We don't have to draw that all down at once.
So that's
right, which is also how VC contributions work. You have the capital calls.
Yeah. Okay. So this is like, hey, future projected revenue over 10 years. If you're doing 10 million a year for 10 years, you'd say, okay, we have in theory 100 million. Is it more like in theory over a long period of time, or are you doing hundreds of millions in revenue? Like what is the revenue of the business, or what like, is that kind of how you're thinking of it?
Yeah, it's our commitment to the fund, so that the fund can call for those funds at any time. Tammy is the fund manager, so she can be sensible about, when those capital calls are being made for investments. And we've also made onwards commitments to some other funds, and at any time they can say, hey, we're about to make, I saw one come across the desk in the last couple of weeks, hey, we're about to make a investment in, such and such company. You please send us, your proportion of the funds that you've committed. So that's sort of how that works, right? It's as a VC fund as any other. From a growth point of view, some public revenue numbers. I think we did 1 million revenue at the end of 2020, and we got to 7 million at the end of last year. So it was, quite a big multiple for us to climb. And obviously we're looking to keep that performance going through this year as well.
Gotcha. So the 100 million has come from outside investors, and that would be what she's using to.
Oh, no, sorry. The funds have come from our own revenue, essentially.
Okay. So business is doing 7 million in revenue. There's some profit margin on that. And then, the 100 million comes from the commitment of deploying that someday.
Over time.
Over time.
That's right.
Gotcha. Okay. And that the purpose of doing that is, in a way, it's kind of splitting it. Like do you tend to run the company and she runs the venture arm? I mean, do you think of these internally as two separate entities? It's like running a venture arm. The only way to be successful is deal flow. And to get deal flow takes time. It's hard to scale venture. I don't think I've ever seen it done. Yeah. Is that, or like, if that is the case, how do the two integrate together?
Yeah, both of us are very much, I'd say 100% on Stronghold. Tammy very much more on the business side, and myself more from a technical point of view. to make sure we aren't, using our own time on that, we will come across investment opportunities just by matter of running the business, right? Partnership opportunities come by. We're always interested in potential acquisitions where that makes sense. So there is some natural deal flow just from running a payments startup, right? You just see the industry and you see other players and you're trying to work with them. The other piece is, and I think this is maybe where there was some confusion earlier, we invest also in funds. So, established VC funds with full-time, GPs, they are out there, they're running the VC game. So we're not going to be making all of them ourselves. We've also invested in a couple funds, and they will do investment. And when they say, hey, you've committed the money, you need to give some to us now. We're about to invest in XYZ company. That's when we have to remit the funds. So, they're out there doing their thing and we've just invested in them.
Gotcha.
So it's not all direct, taking our own time.
Gotcha. Okay.
Yeah.
I'm curious to ask about this token. So you guys have a token. What's the purpose of the token, and what did you build it on? And how did you make those decisions in creating the token?
Yeah. So the token for us was launched at the end of 2018. It was originally an airdrop to we actually had consumer customers at the time, direct consumer customers, and it was airdropped to them as a loyalty token, a thank you. It was a Christmas Eve, St. Nicholas themed. Thanks for being an active member of Stronghold. You've done your KYC and you've used some of our products. Here's 10,000 SHX Stronghold token. And the intent was for them to be able to use it very similar to like a BNB or an exchange token, where it reduced their fees on services that we provided. We decided to issue it on top of Stellar because of our familiarity with that sort of platform. Early on in the Stronghold days, we were working out of the Stellar offices. We knew the team well, and it made a lot of sense for us to easily issue a token, and we had engaged with that community already, so it made a lot of sense there. And so it was, released onto the ledger. People could withdraw it from our system and it would be on Stellar. And then, we really started focusing on the business side, the sort of B2B to C business, and it sort of had a bit of a hiatus for a while. In the last, I think, 18 months, after we had reached that, profitability piece on normal non-blockchain revenue, we started bringing it back into our product as a stickiness feature for our businesses. So first is rewards, right? Which, it's like airline points, but on your processed payments, right? That's to encourage both technology integrators to put our payment system in their product, and then merchants themselves to push our particular payment method through. But the sort of goal now is to have that influence our own sort of DeFi lending protocol. And so that's what we're looking to do as we expand the merchant cash advance program.
And do you feel it's a critical part of the trajectory of the business now, or do you feel it's kind of a part of it that sort of sits on, not mission critical? Sometimes I've seen some projects where the token wasn't intended to be a core part of the infrastructure, and then it just kind of grows, and then the next thing you know, it's like their plans are fully decentralized. And by the way, great on Stellar. I interviewed the CEO, Danielle, at Danelle on a few months ago on the podcast from Stellar.
Nice.
Yeah. And I love what they're building.
Yeah. We think it's absolutely fantastic technology I think it's underappreciated in the space.
Well, let me ask you why. What is it about it from a technical perspective?
Stellar's been around for a long time. And I think that it might be looked as a bit of an old horse. It doesn't have some of the bells and whistles of smart contracts that a lot of newer protocols does. And of course, they're working on improving that and having, side projects that you can use that, plug into the chain to give you those features. But for a lot of use cases, you just don't need a lot of, the features that some of these modern ledgers bring. Stellar is fantastically fast, environmentally friendly, cheap to use, cheap to run, easy to integrate with from a payments point of view. I think that they've, got one of the best architects in the space, Jed McCaleb, right? He did a good job at Ripple, then he got to rewrite it essentially for Stellar. Absolutely fantastic from a technology point of view, and they've got a great team. It really is just a pleasure to use, as a lot of other blockchains aren't. I would not say the same about them, when you have the right use case. And I think that a lot of the interest in the space has moved to use cases which don't happen to match Stellar, but a lot of real world transactional use cases do. So I think that's where there's a big disconnect, right? Everyone wants to write smart contracts and DeFi composable contracts these days, not think about what feels more boring, just, point-to-point payments.
And if you were starting a company from scratch, say you're building some DeFi tool, some insurance DeFi project, how would you go about assessing the different products that are out there, the layer ones, layer twos? Like, the landscape changes so quickly. How would you make sense of the whole situation to decide what technology to build on? Because so many different projects have the same message, which is like, build here. We have the best this, the best that. They're all in on attracting developers. And so from a developer's perspective, you want to make sure you choose the right project, because once you're in, it's typically a long road before integrating multi-chains and so on and so forth.
That's right. From our point of view, when we've, been working with customers who want more direct access to blockchain, and they've asked similar questions of us, one of them is just longevity, right? How long has that project actually been around? How long has their team been stable? How have they responded to outages in the past is a huge one as well, right? It's easy to point at certain chains and go, okay, it's never had an outage, or alternatively that they have had an outage, that's good or bad, and make a judgment over that. But inevitably everything's going to break at some stage. How did they respond to that? How did their team respond to it? So that's a big piece of what we look at. That they've been around for a long time and they haven't been, forking all the time and changing features majorly. That's always a good sign. I think that another important thing is how close to the chains you actually need to be. Can you abstract yourself away a little bit so you could be portable? Internally, we've built products that sit with just a little shim layer, can sit on top of Ripple or Stellar or Ethereum or whatever it is, right? We've had to interact with multiple chains. So not necessarily using a multi-chain protocol, but actually just, bolting down into one of them specifically, but you can yourself move it with little technical effort. Seems like a really good thing to do. I think, if you can do the seconds, then that gets rid of a lot of the issue. But for us, longevity and stability of feature set is really important.
And would that be like,
I think personally,
go personal, go like non-Stronghold, like you're starting de novo, new project. Do you go and like get into Discord and
So, I'm certainly in a lot of Discords lurking around. It's always a great place to find itself on the other side. I'm really loving a lot of the DeFi protocols that are composable and sort of build layers and layers on top of each other. I very much enjoy the curve wars. That's immense fun, what's going on in there. But if I was going to build my own protocol, I'm going to be boring. I think that boring is great in this space. I want more boring blockchain, right? Where there's no exciting news. We're just getting on with it and building businesses, right? So I would probably pick Ethereum over anything else, just for the fact that it seems like it's safer bet than a lot of the other protocols out there. I think from a business point of view, I'd probably overlay it with, okay, what are the partnership opportunities that might exist that might for me one way or another? But if I needed smart contracts, I'm just going to go for Ethereum. But if I don't need that, there's a lot more, Stellars, Ripples, or SRP ledgers, great for if I'm just doing payments.
And do you think it makes sense? So Ethereum certainly is in a place now where they're going through a major change, moving from work to stake. Do you see them as a layer to build on, or do you think it makes more sense? Like if you're an average developer saying, hey, I want to get into Web3, I want to start building today. Is the vast majority of surface area available to you on these layer twos that are, consolidating transactions and then, sending them to Ethereum? I think of Ethereum kind of conceptually as like, that's the ultimate reconciliation ledger, but then there's easier to interface with, cheaper, faster, better in many cases, depending on the specific dApp you're building, layer twos. And I would think intuitively that your answer would be like finding one of those, but does it still make sense targeting it, going direct to Ethereum?
I think that if I was, a small developer team and I was newer to the space, absolutely work with whatever chain has the easiest to use developer tooling and feels friendly. Absolutely. It's going to matter less what, underlying blockchain you use. I think if you're looking to do something a little bit more enterprise scale, and that does need to interface with the blockchain, like you're going to have a lot of transactions on internal systems anyway. Ethereum's still a safer bet. Because as you say, it's kind of the ultimate clearing chain anyway. There's just too many layers of additional risk every time you add one of these protocols on top. And I still feel like a lot of them are basically untested for a lot of use cases. Some use cases have been done well on them. But it is just each layer adds new complexity, bridges more complexity and more surface area for attack. So I think from a risk management point of view, and remember I'm talking to, banks and risk adverse businesses a lot of the time, I would have to go for that safer option. And I know that the functionality is there. Yes, it's going to be more annoying to interface with. Currently actually the gas prices aren't too bad at the moment. It's a bit more clunky. But if I'm building something robust, I am going to make that decision. I think.
What person or book or podcast or YouTube channel, what comes to mind when you think of a place or a person that you learned an extraordinarily high degree from or a lot from?
I think for me, I tend to focus less on individuals, and I wonder if it's also partly cultural. Coming from New Zealand, where we have a thing called tall poppy syndrome, right? Where you don't want to sort of stand out among the rest of your peers, right? So maybe it's a more collectivist view, but to me, it's more likely projects that I think are interesting and the team working behind them that I find more inspiring. And I think that one of the big ones has to be early on Ripple, right, or OpenCoin. And just, it felt a little bit against the grain and doing traditional currencies instead of, new forms of money at the time. That was, I think, brave when they did it that early, right? And it's easy to forget that that's actually what they pushed back then. The business model is very different now. But I think that's really, really where I found a lot of early inspiration. I couldn't single out any one individual as such, but I think that and looking at DeFi, really the only way to learn about it properly is to jump into the Discords and have a look at how communication works there. It's fascinating. But that's really where a lot of the learning happens, as opposed to just listening to what their spokespeople might say. In fact, I think that could be quite dangerous in the space to be in this, in crypto.
Yeah. I would imagine you'd say the difference between the two is that the spokesperson is communicating just the highlights, whereas Discord is the reality.
Absolutely. Yeah. And people are pushing for transparency in a lot of those channels, right? Sometimes quite annoyingly, I'm sure, for the Discord admins, but they will push and nag. And it's interesting to see how these projects even respond to that nagging.
Yeah. I mean, there's so much historical momentum in how you build companies, whether it's companies or countries or politics or internal politics in a company. It tends to hedge, right? Like the executive team determines what they want to share. They tend to share good news. Like rarely do you go on podcasts and say, well, last week we got hacked and, we had to fire 5 people and I was in depression. It's like, well, we tend to screen that, right? And that's human nature. You do that with your friends. Like we do that when you meet people in all contexts. And then it's like crypto wants to flip that and be like, show me all the ugly stuff, show me the loss, some of the transaction time down, is the gas fees, the everything. And it's like, well, when it is public, you kind of have to. And this I feel is almost a friction or a rub inside of companies / projects when a company starting off as an LLC dev shop builds out a intentionally DeFi tool or just generally a decentralized project, that all the information is public, all the code is public, the Discords are public. And so if things go wrong, it's like, it's hard to decide what information, and if any, can be strategically withheld for the process of determining it. When you have a co-founder, you talk about all the shit that can go wrong and is going wrong and people that are going wrong and all the things. And you're like, you have that engine room. So then you can come out and be like, all right, we got the answers. And if you're working through all that in public, it's like, it can be brutal,
Yeah, and dangerous.
And dangerous. Yeah. Yeah.
Where does that disclosure? Where does the line sit? Yeah, it's a tough one.
Yeah. Cool, man. And where are you? Are you on Twitter? Are you writing anywhere publicly, personally?
I have a Twitter that I, will endeavor to use more by more. Not exactly prolific on there, but you can find me on Twitter at it's Sean Bennett.
Nice. Sean, this is fun, man. Thanks for hopping on today, and congrats on all the progress of everything.
Thanks very much. Good to talk to you, Mike.
See ya.